The markets reacted to those CPI numbers this week as the S&P 500 gave up 0.4%, but still ended over 5,000, which puts it 10 points above the Bloomberg L's year-end median number of 4950. The Nasdaq lost 1.3%, while the yield on the 10-year was up 10 basis points to end the week at just about 4.3%. To explain the market's reaction, we welcome now Lisa Erickson, head of public markets at U.S. Bank Wealth Management. Lisa, thank you so much for being back with us. So we heard from Larry about what happened with the economy. Tell us about how the markets reacted to those numbers that we got.
Well, it was really certainly a seesaw week in the market. And to your point, on the back of those hot CPI numbers, the market really had a tough reaction. And if we were to step back and really think about what was driving that tough reaction, it really would be well captured by the words growth, inflation, puzzle. And what I mean by that is really up to this point, and as Mr. Summers had mentioned, we really had a situation where the market was looking at everything in a very Goldilocks fashion. We've had inflation coming down, and yet growth has remained in the okay zone, slowing a little bit, but generally beating some expectations. And really what happened with that Tuesday hot CPI print is the market finally realized, oh my goodness, it's not necessarily a straight line down on inflation. And therefore, the Fed may not be able to cut interest rates as quickly as we think. And so really there was that difficult reaction on Tuesday. And then again today, when some of those more tough PPI numbers as well also rattled markets to a little bit.
We've been in a bull market when it comes to equities. How much of that is because of anticipated cuts of the Fed? Because you heard Larry say, I don't think it's any time to cut anytime soon. And in fact, there's even a chance, 15% chance the next move will be up. The markets, I suspect, are not prepared for that.
Well, certainly when we have looked at the data and analyzed really what's been driving markets really over the last many months, it has been highly correlated with the fact that rates are expectations have been very sanguine. And so that really has been a very recent driver, actually until really the more recent past, when some of these positive surprises that we're getting on macroeconomic indicators indicating growth being better than expected has then further carried the rally. But again, both of these things are still very much in focus. And again, I think what you see from the reaction this past week is that, again, if we continue to see concerns that inflation may throw off that Fed rate cut path that the market was expecting, we can have a pretty tough reaction.
We certainly have been in a bull market. A lot of that's been driven by that Magnificent Seven, whatever you want to call them. How concentrated is the drive in the markets at this point, or are you seeing some dispersion?
Well, certainly throughout 2023 and most of this year to date, we have continued to see leadership, to your point, really from the largest stocks within the market, as well as very concentrated in terms of more secular growth names, particularly technology. Now, what's been interesting since we flipped the calendar on 2024 is we certainly had some spouts of smaller companies and cyclical companies really trying to come back to the fore, but they really have not been able to maintain a steady run at it, such that the leadership again remains very concentrated. And that is one of the reasons why, even though we recognize the macro fundamentals have generally been okay, again, with inflation coming down and growth doing okay, we have not really felt like there's an all clear signal, because when you look at how the market is reacting to that, again, it's very concentrated, and we haven't seen a sustained rally to broaden out the breadth of participation.
Where do you see possible opportunities for investors on either the fixed income side or the equity side right now?
Well, certainly, even though, again, we don't see necessarily a fat pitch in terms of being over enthusiastic on equities, for example, or overly pessimistic as well, within certain areas, we do see some opportunities. So if we take the fixed income markets, for example, we do see some really interesting opportunities to pick up extra income. A great area, for example, is non-agency mortgages. These are securities that are backed by mortgages that are not necessarily sponsored by the U.S. agency market, but nonetheless have very strong fundamentals behind them. And as we know, the housing market has continued to be supported by quite a bit of demand for people wanting to move into their own ownership. And as we continue to track the credit supporting that, it's very strong. And yet these securities offer some nice extra yield, again, just because they are a less a little bit more complex market for investors to understand. So that's just one example of an area where, again, there's some extra yield that could be picked up with very strong fundamentals.